and I knocked on the doors of a number of different private equity houses saying, do you want to help me, buy out Morgan Stanley's NPL platform?
And what were they selling it for? So you were the enforcer and then the fixer. This must be the biggest fix ever.
It was a big fix, and it was a scary fix. It was definitely not without any sleepless nights. So fundamentally, I still believe in retail, but also from a fixed income perspective, having a higher yielding asset class in a rising interest environment made a lot of sense.
Can you replace the human gut, insight, foresight, lessons that AI can't get to yet? Elmar, welcome to the People Property Place podcast. I'm really excited to dive into your background, so thank you for joining me today.
Thanks for having me, Matt.
Not at all. Well, look, I know you've listened to a couple of these podcasts before, so you'll know that the first question is, how and why did you get into real estate?
I do know that question, and I thought about it. I'm going to be honest. I didn't actually want to be in real estate initially. I grew up at the age of 6. We grew up near a military air base where they had fighter jets, and my lifelong dream was always to become a fighter pilot. So when I turned 17, I was living in the Netherlands. I applied for the Royal Dutch Air Force, and 17 was the earliest you could apply for such a job. And I failed at the pre-selections. They're quite tough, as you can imagine.
Through your height? Or
No, I was still within the limit, within an inch. It's all kinds of psychological tests, hearing tests, just aptitude tests. And I made I've passed a number of them. It's not like I failed miserably, but I didn't pass. And I was literally just thinking, what I'm going to do now. My A levels are selected purely based on what you needed to become a fighter pilot. So, physics, mathematics. And all of a sudden, I was like, yikes, I genuinely thought I was going to be a fighter pilot. I was working during my university degree in the Netherlands on a building site, and I did everything. Like, I was a brickie, I was doing tiling, I was helping, the electricians, I was doing painting. I even drove a bulldozer, to help move ground. And it was fantastic. And I always used to like building stuff and seeing the end product. And I thought, I'm going to do a broad degree. So I studied management, economics, and law. But it was a specialization you could do in real estate. So that's what I did. And once I finished my university degree in the Netherlands, I came to the UK about just over 2 decades ago, where I also studied real estate, European real estate, which was fantastic. I love the UK. I fell in love with it for many different reasons. The countryside is fantastic. The Netherlands is flat as a pancake. Here you got hills, which is amazing. But also just the work ethos. I think, there's no real restriction in terms of making a career. So in the Netherlands, it might be a bit more age restrictive, if that makes sense. Here is just very much a performance culture. So if you do well, you move through the ranks, and I really like that. Yeah.
Was failing to get into the Dutch Air Force, was that the first big setback of your kind of life? Because I get the impression that you're someone who, studying maths and physics. You're probably pretty academic and sporty as well. Like it doesn't seem like you had that too many challenges, as it were.
I was disappointed for sure, and I thought about I could either do the commercial route, so become a commercial airline pilot, which, having spoken to a number of commercial airline pilots, it wasn't probably the way I wanted to go. I wanted probably to be more of a maverick, But I started flying gliders at university. So, and gliders, I don't know if you know, but gliders are fully aerobatic. So you can do loop-the-loops, you can fly upside down, inverted. So I still had the thrill of flying, and I still fly to date, but maybe not as a profession, more as a hobby.
So you moved to the UK, and am I right in saying you landed at IPD as a senior performance analyst?
Yes, that's correct.
That was your first role in real estate?
Yeah. And that was a research job. So I did my dissertation in, quite statistical analysis. You were right about the academics, but I really enjoy, understanding the statistics. So does diversification necessarily mean that you're going to get better returns, or is it going to be more balanced? IPD had all the data that I needed, so I got in touch with them. They kindly provided me with all the data for my dissertation. I won an award for it. from JLL, I think it was, best dissertation, I think, of the year. And IPD offered me a job afterwards. Really enjoyed it. It was very research heavy, but it gave me a very good intro in the European fund market, understandings of, performance, what drives performance, and IPD was, a good learning school, yeah.
You did that for 2 years, and then you moved to Fitch Ratings.
Correct, yes.
Why did you do that?
So I studied, economics and real estate, and I always liked the finance part of it. And at Fitch, CMBS, I don't know if you know CMBS, but the CMBS market was booming at that time. And I was very intrigued to sort of understand how it worked and just to get involved in it. I actually had a job offer from Credit Suisse on the lending side, CMBS lending. But the hours were brutal. The pay was actually not as good as people think it is. And I thought at Fitch you get a much broader sort of experience working with different banks, different issuers. It was a good intro to the structured finance world.
Yeah, so you were rating CMBS loans effectively.
That's right. Yeah, but it only lasted for a couple of years because then the market imploded.
And so how? In 2008, what was your kind of thought process when the market imploded? The world turned upside down. You were, 4 years into your career or so? Yeah.
It's a very good question. I mean, I went back to Credit Suisse, and they were setting up I thought the world was going to implode. There's going to be buying opportunities. Credit Suisse was setting up a distressed debt fund. Not distressed debt fund, distressed real estate fund. So I got in touch with them. And I got hired as assistant vice president to help on the asset management side, setting up a distressed fund, which I thought was the perfect timing, right? The market is melting down. They're going to raise capital. They're going to invest. Little did I know that it was very difficult to raise money, obviously, in that climate. So that didn't last that long either. And then after that, I thought, okay, so now we're going to figure out what to do because, we were literally in Canary Wharf. Opposite us, we could see, Lehman's emptying out, in September, I think it was 2008, if I'm not mistaken. Lots of people were laid off, obviously. And little did I know that 3 months later, it was our turn. Credit Suisse laid off a lot of people, and I was one of them. I thought, what am I going to do now? I can do an MBA, or I can figure out where there's a need for my skill set. And my skill set was real estate research and also structured finance. So I had all the CMBS issuance, like billions and billions and billions of securitized real estate loans that needed to be dealt with. I got in touch with Morgan Stanley. And luckily, the head of special servicing, as they called it, the NPL team effectively, just left. So there's a vacancy. I joined.
Right time, right place.
Yeah, right time, right place, in the middle of the storm. Very fortunate in that sense. It was a fantastic team. And within a couple of years, I found myself running the team, the whole NPL team. And when I joined, we had one non-performing loan. When I left, and it had nothing to do with me, when I left, we had about billions worth of NPLs, obviously because of the market meltdown.
So for people listening to this, there's a few kind of jargon words that you've used already. CMBS.
Yes.
NPLs.
Yes.
Can you just explain, because I think it will inform
of course, yeah.
further on in terms of our conversation. What is a CMBS and special servicing, and then also an NPL as well? And where does that fit into kind of the world of real estate?
Yeah, so CMBS is a collateralized mortgage obligation, effectively. It's a loan on real estate that they bundle together. Rating agencies then sort of tranche it up. So they say what risk is associated with each tranche. They securitize it, so they sell it on the capital markets, if that makes sense, on the open market. And it's just a nice way for banks to get cheaper access to financing. But like I said, it's the underlying collateral is real estate, which is what I was really interested in. But the structured finance wrapper, if you want, that was the fun part, putting it together. And now at Morgan Stanley, trying to unravel that. An NPL stands for non-performing loan. So when a loan stops paying its interest, for example, it becomes non-performing, and you have a mortgage over that property. So you could then either restructure the loan, so by maybe reducing the interest rate, maybe extending the term. So that the loan becomes performing again, so it becomes a re-performing loan. Or you do what I used to do, which is just enforce. Because my Dutch mentality, I'm very pragmatic and very to the point, is that, unless the sponsor of the loan brings something to the table, so they're putting in additional equity, I might as well just take it back myself and, clean it up, because our mandate was to maximize recoveries and give as much money back to the bondholders as we could. So I got a bit of a nickname in at least in our team, and I think maybe a little bit in the market, of the enforcer, because I just used to enforce on loans quite a lot, whereas a lot of other sort of, special services were sort of extending and pretending, as we would say, just extending the maturity, reducing the interest rate, and then deal with it later in the hope that, values would recover.
But when you enforce on a loan, it's not all upside, right?
It's not all upside. No, that's right. So, you have to
You don't want to enforce on everything.
Absolutely.
And there's downsides to kind of enforcing.
Yeah. So you have to look at, your security package first and foremost. So, do you have share pledges over the entities? Do you have a fixed charge mortgage? Do you have rent pledges? If I have the feeling that, there's limited downside in enforcing, and therefore I have control over the asset and can manage it maybe upwards, you don't necessarily have to sell it straight away. You don't have to put it in an auction. You can also hold on to it for a number of years, put a new asset manager in place, maybe even recycle some of the capital, inject some money. So a good example is like, you might have had an office that was maybe, say, 50% occupied, therefore it breached its loan covenants. We would take it back on not on the balance sheet, but, we would take it back the asset, invest in some CapEx, lease up the building, and maybe sell 1 or 2 years later at a much higher price. And ultimately, that was our job, to recover the maximum amount for the bondholders. And it was tough, but really good fun. And we covered all of Europe. And in the UK, for example, it's very easy to enforce. You go to France or Italy, it's much, much harder because there's all kinds of protection mechanisms in place. So I spent a fair few days in court trying to defend why we should enforce on a loan. And you have to remember, at this age, at this time I was only about 29, I think. So still quite young, but it was fun.
And you got nicknamed the Enforcer. So can you just talk to me about some of the numbers at Morgan Stanley, the quantum of deals and the types of deals that you were kind of maybe enforcing on?
Yeah, sure.
Just to give us a bit of a flavour.
Yeah, I think the loan book. So Morgan Stanley is very successful in sort of lending and then wrapping up the loans, securitizing it. I think a lot of banks were doing this at the time. It's just an efficient way of sort of getting cheaper capital. I think the loan book was probably about 10 billion plus. So it was a big loan book. When I joined, as I said, 99% was performing, but that was just the start of the downturn. But yeah, I think by the end of it, it was like, a few billion worth of non-performing loans that we had on our books. And we cleaned up a substantial part of it. So that was definitely an interesting period of time. The problem is, like, during this time, so this was 2008 to 2013, Lehman's was struggling, Goldman's and Morgan Stanley's also, their share prices decreased quite significantly. So what Morgan Stanley did is they looked at what is our core business and what is our non-core business. This was classified as a non-core business. So, after like X number of years on the job, we got notified as a sort of, medium, mid-level management that, the business was going to be sold. And I always wanted to run my own business. So there I was, 29 years old, made a little pitch book, and I knocked on the doors of a number of different private equity houses, saying, do you want to help me, buy out Morgan Stanley's NPL platform?
And what were they selling it for?
I can't disclose that.
But for a 29-year-old, it was a big sum and a big ticket. Yeah.
It was millions, but I didn't have access to that kind of capital. But for private equity players, it was just not significant enough. Yeah. The bigger the better, often for some of those firms. So I wasn't successful in that, but that did lead to my next role at Oaktree Capital, because they called me up a few months later saying, like, listen, we can't help you buy the platform, but how about you set up a platform from scratch?
So before we get onto that, did you have any friends or family in real estate?
No, not so much. No, my parents, they built a couple of houses that they lived in themselves, so purely as a primary residence. So I used to help a lot on the building sides, and hence I got to know a lot of people in the building world. So I had lots of job on construction sites, and I thoroughly enjoyed that. It's just something special about creating something with your own hands, and after 6 to 9 months, you build a house, you can see it, and that's what I really liked about it. Going purely into finance, maybe trading options or swaps or anything abstract, I would call it, just didn't appeal to me that much.
You like the physical, the tangible nature of
Correct.
Property.
Correct, yes.
So where did the desire to want to run or own your own business come from?
My wife would say I'm stubborn, and I like to be in charge of my own destination. I think you hinted at that at the beginning, but it's true. I genuinely believe that, you can create, to a certain extent at least, the path you're choosing, right? So if you want to be in charge of that, what better way than to run your own business? So I always wanted to run my own business. So when I was studying business in the Netherlands, and I was probably 18 years old or so, there was a friend of mine that was looking to take over an advertisement business. He was a few years older, and he knew I was studying business. He said, "Can you help me write a business plan?" I said, "Sure, I'd love to." It was really interesting. And we went to a bank together, trying to get a loan for the buyout of this company. So in a way, it was sort of our first M&A transaction. He was successful. He bought the business. I wasn't involved in the day-to-day running, but it was just the first sign that, this is what I could be doing. But I also knew that I felt like, it was probably better to go through the corporate sort of, process first, learn a bit more about myself, about the world, about the corporate environment, all the soft skills. So yes.
And is that why you particularly liked enforcing on transaction as well? Because then you could have ownership of the assets, and then you could control actually the plan, the business plan, and the value creation, and get some of the upside?
Yes and no. I mean, first and foremost, we had a fiduciary duty towards our clients, obviously. So we want to make sure that, we maximize recoveries. It was not sort of a
personal
power
ego
trip
driven
or anything. No, it's very much like, how do we maximize recoveries? And we didn't always enforce. We had some really good operators there that were just unfortunate that the value dropped and therefore they breached the covenant. But we could see that, these were best-in-class operators. So we're very happy to sort of, keep them on board and work with them to maximize recoveries. And this is actually something that continued when I joined Oaktree. This same approach was very similar. So focusing on what do you bring to the table versus what is my alternative.
So you joined Oaktree having tried to pitch them to take Morgan Stanley's kind of NPL platform out. They didn't back you to do that, but they said, we like what we've seen. Why don't you come in here and head up our kind of European loan workout platform?
That's right.
Can you just talk to me about your time at Oaktree and the kind of deals that you're involved with?
Yeah. I mean, So Oaktree Capital is very big and very successful in the debt market, distressed debt market as well. And the team was very refreshing to me. They're sort of very energetic, very smart people, and they had already bought a big NPL portfolio. So it's not like they were completely new to it. They already had some real estate NPLs on the books. They were in the midst of sort of trying to build a team around it. And I joined them as head of loan workout. So effectively dealing with the problem loans and trying to, maximize recovery. So this was more of a loan to own strategy. So not necessarily maximize recoveries to quickly return it to the bondholders, but very much to own the real estate, add value, maybe ride the curve a little bit, and then sell. But it was bizarre. I remember joining with an Oaktree business card. They had an office for me in Basinghall Street in the city. And I can't remember how big it was, maybe 2,000 square feet. And there was about 20 empty desks. So they said, here's your office, build a team, start buying NPLs. There was a few people, secondees from a big accountancy firm. And they had, a couple of permanent staff, but the team was absolutely minimal. But it's probably one of the best jobs I had for that reason, because you're building something, you're building your own, it felt like my own platform, right? And in the end, we managed to buy a couple of billion worth of NPLs. And I always remember, like, we enforced and resolved about 50% of those loans within the first 3 months of buying it. We were very efficient. Yeah. It was a really fun job. And I'm still in touch with some of those guys. They're fantastic people. We handpicked those people, obviously, and was interviewing, every week someone, because we're just growing the business. And I would say, like, that's where the desire to become an entrepreneur was even more, reinforced, because, like, building something, creating something, that really gets me going.
And so did you just, by this stage, did you just have a knack of just being able to spot opportunity and mispriced assets or problems, and you could just come up with solutions based on the track record that you had, just in terms of how you can work it out super quickly?
Yeah, so we had a team at Oaktree, and at the time it was called Sabal Europe, which is now called Victoria Asset Management. They had sort of teams that were focusing on the real estate. I was mainly focusing on the loan side of the business. So we would buy these loans, and the other team would look at the underlying real estate. But, sometimes you see a fantastic piece of real estate, but if the loan security package, if that makes sense, doesn't allow you to get to the real estate,
you're not interested.
Then you're not interested, or you shouldn't attach much value to it in your underwriting. So it was very much a team effort. But I would look at the loan side, and it became a bit of a joke, because we used to sit in these credit committees, and they're talking about this real estate, and I was like, excuse me. So you can't actually get to the real estate here because of the security package. So you can spend a lot of time on it, underwriting it and analyzing it. But if you can't get to it, it doesn't make sense to spend much time on it. And, because we were always dealing with problem loans, and sometimes, like quite messy loans and quite difficult borrowers, it could get quite messy. I'll happily tell you a bit more of a couple of beers.
Not for the podcast, Mike.
Not for the podcast, unfortunately. But so I've got a bit of a nickname there as well, the Fixer. So when I left Oaktree Capital, they gave me a nice sort of picture as the Fixer, which I still have at home.
So you've gone from the enforcer
to the Fixer.
So you were there for a year, if I'm not mistaken.
It's about a year and a half. And the reason for that is that, before I joined Oaktree, I was interviewing with Blackstone. I knew some of the guys there. I was pitching some ideas to them, not necessarily looking for a job. I was actually genuinely pitching ideas. But, I really liked the guys there. I didn't know them that well, to be honest, at that point in time. I interviewed there. I think James Locke was on one of your podcasts. I think he mentioned something about the interview process, that it took a long time to get through all of that. I must have had well over a dozen interviews there. All nice people, but it just took very long. And Oaktree came and said, like, listen, we like you. Come and work with us. And I think it was done in 72 hours. So I joined Oaktree, and then it was not until Blackstone came back a year and a half later saying, are you still interested? That I couldn't say no, really. It's an amazing company, and they had some really interesting stuff on their books that I was allowed to work on.
So was it a bigger job? Was it wider ranging? What was it? Was it the brand? What was it specifically?
Well, I met with Peter Stoll. He was at the time the head of asset management at Blackstone. We had a very nice chat. And I remember asking him, like, what is a job description? He's like, well, there is no specific job description. We're just very big. We're growing a lot. They're very successful at deploying capital. Come and join, and you'll see. The one thing he mentioned, because I explained that I've got an MPL background, is that, they bought the debt on this company called Multi Corporation. So they bought the debt on a big corporate entity. I said, this could be good for you with your MPL experience to work on that. So I thought, that's quite interesting. I've never done a corporate loan. I've done real estate loans, but not a corporate loan. So when I joined Blackstone, I spent probably 90% of my time working on Multi Corporation, which 10 years later, I bought from Blackstone.
So in terms of that file that was dumped in your desk at Blackstone, can you just tell me a little bit about what you saw and why they bought the debt, and what you were kind of brought in to do specifically? Yeah,
of course. So Blackstone bought Multi Corporation, I think, because of the underlying real estate. There were some really interesting assets in there, like trophy assets, but they were mainly a shopping center developer. So they had some really good shopping centers in there. At the time, the retail market was actually very, very strong. They had a lot of exposure to Turkey, for example. There was talk about Turkey maybe joining the EU. So you could definitely see the reasons for why they invested in the platform. My job was, so they did a debt for equity swap. So they swapped the debt for equity to become the owner. They restructured the business a little bit. And at the time, there was a lot of money to be made, I think, in the retail sector. So they were quite aggressive in deploying money in the retail sector. Multi became the platform to run those retail assets, to manage those assets. The same way they might have had Hilton for the hotel business, Logical for the logistic business. They had Multi Corporation for the retail business. So I spent probably 90% of my time on Multi. I was dealing with sort of the C-suite, with the CEO, the COO, the CFO, and just really sort of trying to sort of make sure we focus on the right things to maximize value of the underlying real estate. That said, Blackstone also bought a lot of loans, particularly in Spain. So they bought non-performing loans and also reperforming loans. So I remember, James Zabala, who was at the time the head of acquisitions, asked me to get involved in seeing if we could maybe do something on the structured finance side to securitize at least the performing loans. So that, given my background in the CMBS market, I've never done RMBS, but it's a residential mortgage-backed securities. So I jumped on that and I said, I would love to get involved. He allowed me to hire, one guy who's a fantastic guy. And
Only one?
Only one, yeah. I know, like at investment banks, you probably have a whole army of people. But I hired a guy that worked with me on this. And he was very bright. He's still there. I won't mention his name. And we managed to create this RMBS securitization program that was very successful. I think we issued probably about close to 900 million euros worth of RMBS securitization. So,
wow.
And ultimately that led to one of the bigger sales, because they sold that whole portfolio to another private equity fund. And we created a lot of value, I think, for the shareholders and for the investors. So it's a very successful deal.
Can you talk about any other transactions you were involved with at that time?
I did a lot of things at Blackstone, and I think that's what made Blackstone so great, because they had such a big portfolio. I was one of the earlier joiners, I think, before they became much bigger on the asset management side. So I was also involved in the office market, for example. So I was running or helping with the German office investments, which is not an easy market, 2014. And Blackstone, so mantra is like buy it, fix it, sell it, right? You've probably heard this. And they bought good buildings, but with like vacancy, maybe undermanaged. And our job was to lease up that vacant space and create value for the LPs. We were very successful in that. And I was focusing just on the German office market. It was a tough market. But I think, under their leadership and guidance, they could really help you, excel in your job, but just really focusing on the right things. So for me, that was, from a personal perspective, I learned a lot from the guys there. But I also helped temporarily with a public company that they took private or partially private in Sweden on the residential side. At the end, before I left, I even helped on the logistics side. So, you got lots of exposure to different markets, different asset classes. But retail, I would say, was always my main focus through the management of Multi Corporation.
Quick one from me. If you haven't already subscribed or followed this show on the podcast or app where you listen or watch, please do. It takes 10 seconds and helps tremendously. I've got really big plans for the People, Property, Place podcast, and that one small action really, really helps grow the show and the presence and enables us to keep doing what we're doing. So if you haven't already, please follow or like on the platform you watch or listen to. Thanks so much. And retail, was the darling child for a number of years.
Yeah.
And then it had a sudden fall of grace, right?
Yeah.
And it was a pretty dirty word for quite a long time. Is that why, being a contrarian investor, you were interested in it?
I think retail, you're absolutely right. I think retail was doing really, really well. It's a very diversified product. If you think about the underlying tenant base, right? If you have a big shopping center with over 100 tenants, you have a very diversified sort of income stream. It's not like an office where you might have one tenant. So it makes a very stable investment. I think what happened, and Blackstone is very good at sort of, spotting trends globally. They have this famous Monday meeting where effectively all the offices around the world sort of dial in and they discuss of, what's happening in the world. They saw a trend that, like retail was probably, struggling a little bit in the US. The wind comes from the west, or whatever the saying is, right? So what happens in the US tends to come to Europe. And they preempted that by sort of, starting to sell some of the retail investments very successfully. But that also led to multi effectively managing less and less for Blackstone. So the relevance of having multi-corporation as a platform became less and less. But and that ultimately led to the management buyout that we did a few years later.
Before we come on to that, can you just give a little bit of history to Multi, when they started and their journey up to present day?
I mean, I don't know the full history, but what I do know is that they were founded in 1982, so they're over 40 years old. They used to be one of the most prominent developers in Europe. They're very, very successful, also very creative in terms of what they were doing. Like ESG is a bit of a buzzword these days, and I know there's a lot of focus on it. But in the 90s, Multi already developed very, very, very sustainable office buildings in the Netherlands with rainwater collection, solar panels, which sounds pretty basic now, but 30 years ago that was pretty advanced. So they're a very prominent developer, not just on the retail side, but also offices. They built some hotels, resi. And they were taken over at some point by Morgan Stanley, effectively, or Morgan Stanley lender against them. Then Blackstone came along, so they had some change in ownership, effectively. But it was not until Blackstone got involved that effectively they took full ownership of the platform.
But it had a meteoric rise and also some challenges as well, right?
Yeah, I think being a developer, so in the great financial crisis, is quite tough, right? Because their business model works on the basis that you can develop and sell. When the music stops, effectively, it becomes a lot harder. And then if you then also have a lot of leverage, sort of debt financing, then obviously you might struggle and you might become that NPL borrower that you don't want to become.
Talk to me about the management buyout that you just kind of alluded to.
Yeah, like I said, I think Blackstone saw what was happening in the retail market. They sold a lot of the retail. Well, I sold a lot of the retail for Blackstone, effectively, that they were managing in Europe. Quite successful in doing so at the right time, I think. And they made some really good investments. But the platform, multi-corporation, at the time was about 600 FTEs. It was a big platform. And because the retail market was deteriorating and because Blackstone had sold already a lot of their retail positions quite early on, the relevance of keeping that platform became less and less. And then COVID hit. And because COVID hit, obviously, the fees started drying up. Shopping malls had to be closed at a certain point. So, there was a unique opportunity for me to step in because, I knew Blackstone wasn't sort of, investing in retail at that period of time. And I teamed up with the CFO at Multi, Stephen Pullman, who's now the co-owner and co-CEO of the business. We saw a future still in retail, whereas I think, is a good time for Blackstone to maybe dispose of the platform because that was not their main focus. And they had already, cashed out on sort of, a lot of the good investments that they had made. So, it was an awkward conversation. I won't lie about that, to say hey, listen, guys, I would love to buy the platform if you allow me to. But we put some serious thought into this because I could sort of foresee a scenario whereby if you make the platform a bit more efficient, heavily invest in technology to really make the business more profitable and also more innovative. If you can weather the storm, retail will come back. and it is already coming back. And I'll happily explain to you why I think it's a good investment class. And that's exactly what's happening now.
So you thought I'd catch the mother of all knives and and buy this European retail platform.
Yes.
You'd obviously tried that before, previously at Morgan Stanley, and it didn't work out.
Yeah.
This time it was different.
It was very different. Yeah.
Talk to me about those conversations that you had. Was it relatively straightforward, and also how did you go about physically buying it from Blackstone as well?
Yeah, no, it was not an easy conversation. Obviously, you're negotiating with your employer if you want, but they could also see the merit in effectively offloading the platform, which also comes with a lot of liabilities if you think about it. You have 600 people, and if you're not sort of investing in it, why maintain this whole structure? And there's some very talented people that invested quite heavily in the platform. Why maintain this structure? When you're not necessarily going to invest in it. So I think it was a logical transition. They still had some assets, and we still manage, even today, we still manage some of those assets for Blackstone retail assets. So having a friendly face on the other side sort of made sense. And I think they knew I was going to. Hopefully, they knew I was going to do a good job of managing the platform together with Steven. But yeah, we have a very, even I sometimes joke, like, even though we sort of, parted ways, we're still very good friends. We still work together. They might even give us a new retail mandate very soon to manage for them. So, it's a very good relationship there. Having spent a decade in the retail business, like, I understand retail. It's not rocket science, but we also have the benefit of having, roughly 600 people that have been doing this for some of them for over 20 years, But surely,
the wider thematics in logistics and the residential or alternative sectors are more compelling, or there's more upside, or there's an easier route to go down that way?
Yes, but I come out of a fixed income background, right? So structured finance is effectively fixed income. So what do you do when interest rates go up? Are you going to buy a long-dated gilt at a very low coupon, or are you going to buy the high yield bond? I mean, this was my logic. Like, if you look at the underlying KPIs, the key performance indicators, so occupancy, collection ratio, sales, retail was still performing okay. Yes, it was struggling, especially in the US with some of the big anchor tenants going bust, like the department stores, for example. We had some cinemas go bust. But fundamentally, there was still sort of a reason to have a shopping center. And by the way, it's not just shopping centers, also outlet centers, which are doing phenomenally well. Retail parks, which in the UK in particular have been doing really, really well over the last couple of years. So fundamentally, I still believe in retail, but also from a fixed income perspective, having a higher yielding asset class in a rising interest environment made a lot of sense. Logistics also makes sense because of the rental growth. But I wasn't necessarily convinced that that's what I wanted to focus on, because I think you can add so much more value from an asset management perspective on a big complex shopping center than maybe sort of on a logistics center, unless obviously you're Blackstone and you can build a whole infrastructure around it.
So you're the enforcer and then the fixer. This must be the biggest fix ever.
It was a big fix, and it was a scary fix. It was definitely not without any sleepless nights. The main thing is like having so many employees that you're responsible for,
600.
and making sure. 600. I mean, we went from 600, down to the low 500s. We did a big restructuring when we took over the business to make it more leaner, to get it back in the black. But yeah, it was still a concern. How do I make sure that Steven and I are sort of, providing for these people, making sure that, we have a successful business. We had a very, very clear vision of what we wanted to become. And that was quite unique. And it's also quite different from what the business was when we bought it. So one of the key focus things that I was focused on with Steven is I want to be fully vertically integrated. So what does that mean? If you're a big investor, you're an overseas investor from the Middle East, from America, from China, it doesn't matter. You say, I want to allocate 5 billion into the retail sector in Europe. Who are you going to go to?
Biggest player, safest player, most recognized player.
And this is it. Like if you look at our, peers, our competition, There's some really strong players there, but we now have a European footprint of 15 jurisdictions. We've been quite busy. We set up 4 new offices in 4 new jurisdictions, but we're fully vertically integrated. What does that mean? We do sourcing, so looking for deals. We do acquisitions, so underwriting the deals. We do the basic property management, if you want. We do asset management. We do leasing, but we also do developments and redevelopments. Remember, we used to be a big developer, so we have in-house architects, developers, quantity surveyors, and for some clients we still do disposition. So we literally from cradle to grave, if you want, from buying the deal, managing the deal, to selling the deal, buy it, fix it, sell it, and that's what we want to become. I think that's where we are today. And we see a huge opportunity, not just in the bounce back of retail, which is starting to happen, but also in the redevelopment play. So, and again, being developers at heart in the DNA of Multi, we see huge opportunities in repositioning, whether it's retail assets, but also we're starting to segue a little bit into the office sector as well. It's no secret that the office market has been struggling a bit. Especially older derelict offices, energy label Z, for argument's sake. You need a lot of capex to bring them up to sort of a higher energy label, which will be mandatory in the future, right? So what are we doing now? We're strategically looking for office buildings that need a lot of capex, but with a redevelopment or repositioning play in mind. So making it into mixed use, office, residential, maybe some retail at the bottom. And that's proving to be a really interesting thematic sort of investment theme, I think.
So it's retail led, but also kind of mixed use, alternate use underpinning it as well.
Yeah.
How many kind of global LPs, sovereigns have got 5 billion quid that they want to allocate to kind of retail?
At the moment, probably not that many. And that's what we're hoping to achieve in the years to come. What I would say is that, since we took over the business, we won more than €1 billion worth of AUM, assets under management. So this is just assets that we're now managing for other clients. We set up an office in Switzerland the first year that we bought the business. We set up an office in France last year. This year we bought a majority stake in Realm, which is a UK manager. We're expanding our footprint because we want to be in those core markets where we think the market will come back. And then being a one-stop shop, doing from sourcing to dispositions and everything in between, makes us quite unique. And yes, you're right. There's probably not many players that want to allocate 5 billion into retail right now, but we're definitely getting a lot more inbound in terms of people looking at retail again. And I think it makes sense because the high yielding, not all retail is bad. Secondary shopping centers in non-dominant locations, they're struggling and they probably continue to be quite tough investments. But if you have a dominant shopping center or good outlet center, retail parks, the KPIs are actually all pointing up.
What was the personal cost of you buying Multi-Corporation? Because if I'm not mistaken, you've got a wife and 4 kids as well.
You're very well informed. Yes, I have a wife and 4 kids. We had a long debate about, what does it entail for our family? Because, Blackstone was a busy job, but taking on a company on your own and taking all the associated risk was obviously quite a significant decision for us. I would rather regret the things that I've done than not doing them because I'm afraid of making those choices. And that's sort of the conclusion that we came to. My wife has been amazing, absolutely amazing, very supportive. I travel a lot, and it's tough sometimes. But I think the first year, we managed to get the company back in black. And that sort of, gave us a bit of breathing space. And now we're just focusing on how can we make this platform even better. And we have lots of fantastic ideas of what we can do with the platform.
Can you share some of those ideas? And one specifically being kind of data and AI as well.
Yes. Data and AI, I'm very enthusiastic about. I think, there was a time when I was at Blackstone and Multi was managing one of our assets. They want to bring in a big tenant and they said, this is a fantastic deal. It's the right thing for the asset. But it's going to cost you, 4 million quid and the return on it is just 2%. And I'm like, well, that's a tough sale to our investment committee. So why should I do this? Well, because, like this tenant is going to bring like a so-called halo effect. It's going to drive footfall. It's going to, increase the performance of the center. And intuitively, I agree that, this is probably the right decision for the asset. But when I asked them, I said, okay, well, can you back this up with data? Because I need it for my investment committee. They said, well, we don't have the data. This is just a hunch. We think that, it's going to drive footfall by say 25%, but we don't have the data to back it up. So one of the first things Steve and I did is when we bought the multi, we set up our own prop tech business. And it's fascinating how big it is. We have 25 people now, and all the focusing is on data, and more data. Traditionally, what you would get is for a shopping center is like how many people go into your shopping center, maybe how many people go out of your shopping center, but what they actually do inside, you can't actually track.
And
very
also,
accurately.
your occupiers, if I'm not mistaken, they don't necessarily want to share their till data or their data that they're collecting at an individual level with their landlord, right?
Turnover leases are becoming more common, especially on the continent. So we do get turnover data. That's useful. That's useful to understand, how they're performing, how they're trading, and it gives you a bit better idea of where ERVs are, the estimated rental values are for those shops. What we are trying to create, or what we have created already, is our proprietary software that allows us to analyze people that shop in our malls with their consent, because obviously GDPR is a big thing, so that we can understand the patterns, the shopping patterns. So where do people go first if they enter a shopping mall? Do they go to Zara, Massimo Dutti? Do they go to H&M? Do they go to Starbucks? Yeah, I mean, it can be anything, right? And then what we've now done is we hired a lot of data scientists. We're actually working with the public sector. We're working with a big university in the Netherlands. A professor is involved, and he made 30 master students available that focus on data science. They have very little understanding of real estate. That's exactly what we want, because we want them to have an open mind when it comes to analyzing this data. We hired on-sites of data scientists in our prop tech team, and we're just trying to sort of see what the patterns are that we can discover. And we're using AI to help us with this. And I think AI is going to revolutionize the way retail is going to be managed. Maybe other asset classes as well, but retail in particular. So if we can understand customer behavior better, we can also start moving to predictive modeling. And that's when I get really excited. If Matt comes into a shopping center, based on your social demographics, I can probably predict, that's where we want to be at least, what the chances are that you're going to get a coffee. And not just any coffee, like are you going to get a regular coffee, a latte, a cappuccino, oat milk, soy milk, maybe regular milk. That's what I want to understand. And then if you shop at Zara, what are the chances that you will then also go to, say, Massimo Dutti or H&M? Or what are the chances that you'll go to the cinema or McDonald's? So trying to understand customer behavior then allows us to, one, optimize our tenant mix in our shopping center.
And you mean by that the floor makeup and where floors are, or the zoning, or where particular occupiers are located?
Yes, yeah. So we move tenants around to make sure that we have sort of, a good footfall flow sort of around the shopping centers. We don't want to have what we call cold areas, so where there's not much footfall. But also, like if we can predict the chances of, say, I mentioned this hypothetical of, tenant coming in and it's going to bring this halo effect. If I can measure that and then go to my investment committee and say, like, listen, based on the 1 million users that we have for our PropTech software, I can say with 90% certainty that it's going to bring us an extra 10% additional footfall. Therefore, the turnover rents will go up by this much. The mall income will go up by this much. Therefore, it's a good investment. That's much more powerful than saying, well, I think it's the right decision. And unfortunately, that's just still what's happening a lot in our industry. It's not a bad thing, but it's just because of the lack of data that's available. And that's something that we're trying to solve.
And there's nothing that you can buy off the shelf?
No.
And that's why you've gone, we'll build it in-house.
We're building in-house. We're actually using 5 different technologies to sort of, analyze the data. Some of them are proprietary. I think we're miles ahead of competition. And, if you ask me where we're going to be in 5 years, we're going to be not just a real estate retail management platform, but very much a prop tech company. I think data-driven decisions is where we need to go. If we can analyze trends, if we can analyze customer performance and therefore make better investment decisions, that will set us apart from our competition. Absolutely.
Can you replace the human gut, insight, foresight, lessons that AI can't get to yet?
I don't think it's about replacing. I think it's about complementing it. So having that data available and allowing you to make and this comes back to my first job in research, right? Having that data and understanding the data and then making a decision or making a recommendation is so much more powerful than just purely basing on gut feel or maybe your intuition. I think what sets our business aside is that we have a fantastic relationship with some of the biggest retailers in Europe. Like we have over 6,000 tenants across Europe and the UK. We have millions and millions and millions of visitors every year. So having all that data and not doing anything with it just doesn't make any sense. And I can probably tell you with 90% certainty what the footfall is going to be this month for a particular mall that we manage. Because it doesn't fluctuate all that much. Yes, of course, Christmas can be a bit busier and the summers, depending on the location, can be a bit quieter or busier depending on the type of mall that you have. But then translating that to actual sales for the retailers and seeing how profitable they become, that's where I want to be.
Where does kind of e-commerce, digitalization, online experience marry with in-store experience?
Yeah. A lot of stores, a lot of retailers, I should say, focus on e-commerce. And you heard the word omni-channel probably. So they use bricks and mortar stores, they also use online. What we know, based on our discussions with tenants, is that online doesn't necessarily make sense for all retailers. For some it does, for some it doesn't. Think about your hypothetical 14-year-old girl ordering 10 dresses to try on, sends 9 back, keeps 1. Think about the logistics involved in it. Think about, the handling costs associated with that. So the margins go down. Whereas having a physical store, you can try it in the store, hang it back and buy one. So the margins are higher despite the cost of having to operate a physical store. So retailers are becoming much, much smarter as well. And they know that, for example, if Zara opens a store, for argument's sake, in a particular postcode, they know that within a certain radius, their online sales will go up because it acts as a showroom. So when people say retail is dead, it's all going to be e-commerce, I don't buy that for a second. Yes, of course, e-commerce is important, but it's just one of the many channels that retailers use to sell their product.
We've touched on kind of data, AI, analytics, and some operational efficiencies that you've kind of brought into the business. Can you just share a little bit more in terms of kind of maybe the development aspect over and above what you kind of maybe touched on earlier in our chat?
Yeah. So as I said, Multi used to be a prominent developer. So we still have some of the amazing architects that develop a lot of big shopping centers. We even developed some shopping centers in the UK, in Northern Ireland, all over Europe, all the way up to Turkey. We've done over 200 development projects throughout the life of Multi Corporation. Obviously, I only have a small part of that. But if you look at what we're doing now, we bought a couple of smaller assets on our balance sheet. A good example of that is, we bought what we call a convenience center. So a grocery-anchored convenience center. Big supermarket with other retailers around it, maybe a florist, a butcher, in your local neighborhood. This particular one was struggling quite a bit. It's just too big for its local catchment. So what do? We approached the municipality and said, listen, can we just consolidate the retail part in the strongest part of the shopping center, if you want, demolish the rest, build some resi towers on the other bit. And there's still a massive housing shortage in the Netherlands. So the municipalities are very interested in having that discussion. Took us about 2 years, but we've got the zoning change now. And now we can go vertical, so we can build the resi. This is a massive opportunity. And yes, it's risky because you have to get a zoning change. And yes, you might sometimes buy sort of tougher assets. But as long as you're rewarded for that in the risk premium, it's very interesting. And being able to do that all in-house, for us, makes a lot of sense. We bought an office building just before Christmas, which is what I was referring to earlier. Is like the energy label is actually quite low. For the current use, it's probably not the best building. So we're working with the municipality to do an urban regeneration project, not just for our office, but the whole area around it. And we have the architects, the developers, the quantity surveyors to help with that. Municipality loves the idea, building more resi, high quality and high energy efficient. So, office with some retail. This will be a multi-year project. But, once it's there, you're going to really add some value. And this is proper asset management and development management. That's why I see a huge opportunity for the market. Absolutely.
And that's why you've gone vertically integrated.
Yeah.
And so you can offer that as a one-stop shop to a variety of LPs looking to kind of access the opportunity.
Absolutely. And you can also, it doesn't necessarily mean you have to repurpose the building. It can also sometimes just be a repositioning of a existing shopping center. So having a large shopping center, but it's maybe poorly managed, or maybe there was a lack of capital available to invest in the asset. Us coming in as a manager, asset manager, but also a redevelopment manager, we can sometimes bring some of the tenants that would otherwise not come. Just given our expertise, we know how to sort of explain to tenants what we're going to do with the asset, have a vision for the asset, reposition it. We had a case study actually not too long ago. We're still working on it. We took over the management of a big shopping center 2 years ago. Within 2 years, our NOI, our net operating income, is up 25%. Wow. Occupancy went from sort of the high 70s to sort of mid 80s. We expect it to stabilize very soon, so in the 90s. This is value creation. This is asset management. This is what we're good at. This is what we like, and that's why retail is such an interesting asset class, because it's very hands-on. It's an operational asset class, and I think and combine this then with the prop tech business, the AI learning on top of this, you can really knock it out of the park on the investment side.
The size and scale and the footprint you have, and the kind of the backup business plans you've alluded to as well.
Absolutely.
When you take over the platform, you obviously go from Blackstone, real estate, private equity. How did the team respond to private equity kind of going from to being an owner and it being a private company? And then the second question is, how do you go about building a high performing aligned incentivized team as well? That's
a good question. The team obviously sensed that Blackstone wasn't buying that much retail anymore. We're very much in a disposition phase where we're selling assets rather than buying assets. So people were obviously questioning what the future was of the business. So when we took it over, we had a big town hall meeting, sort of explaining to the people what was happening, why we've done it, what our vision was, and our vision was very much to grow the platform, as explained, vertically integrated. Also reignite the development team and focus on that part. Some people were skeptical. I was still relatively young at that stage, and they questioned,
who you are, who do you think you are to be able to do that?
They knew me obviously from the Blackstone time, and they saw me in the office on a regular basis. Stephen they obviously knew very well because he's been working there for many years. But I did have a very clear vision, and that vision is grow the platform, vertically integrate, focus on the development side, on the repositioning. I think there's a huge opportunity to explain this to people. And I remember we took it over in March 2022, the business. At the Christmas dinner in December, I just listed the accomplishments. And I think that was a very powerful message to the people. Like I said, I was going to deliver these things with Stephen and look at what we've actually accomplished. That's actually one of the many reasons why I sometimes keep my to-do list from X number of months ago in my drawer, because it's sometimes quite good to reflect on where you've come from and what we've achieved, because it's easy to forget. So I listed this at the Christmas dinner and I said, listen, we won 1.5 billion worth of new mandates. We opened an office in Switzerland. We bought a number of assets on our balance sheet. We're developing again. That's probably more in 9 months than we had achieved in previous years. So I think that was a real sort of wake-up call for people that were maybe skeptical, that we were serious. And listen, all of our money is invested in this business. We want to make it a success. I am a bit of a fixer, and Stephen is the same. We absolutely see it the same way. You know, we want to make this business a success. We see it as an opportunity, and we're delivering. And the year after, the other Christmas party was even better because we now open an office in France, and we expanded the platform even more. So I think that really helped show people, rather than saying what we're going to do, we showed people what we did, right? The second question, like how do you keep people motivated, how to keep high-performing people in the business, and how do you motivate them? We're very, very fortunate because Blackstone invested heavily in the business. We have fantastic people already in the business. You know, we automated a lot of things. The infrastructure is fantastic. All the paperwork is squeaky clean. So, you know, we had a very nice business, very solid foundation to build the platform. And one of the things I've learned, mainly from Blackstone actually, is like share your successes, right? So when we do a deal, regardless of how big it is, and it doesn't need to be on the investment side, it can also be on the IT side, for argument's sake, or a leasing deal, share it with the company, show what we're doing as a business, and show that, you know, we're successful at what we're doing. Another thing is you know, we have a very flat structure. You know, there's very little egos in our business. We want people to speak up, regardless of level of seniority. So we do have, you know, regular meetings where we just ask people, anyone, for their feedback. And it's really interesting. Once people see that, you know, they can actually speak up and that we actually do follow up, you know, people speak up more. And I always say, like, you know, anything you want to discuss, email me privately, absolutely fine. I just want to understand sort of, you know, what's happening on the floor, how we can improve things, regardless of level of seniority. And I think ultimately what Steve and I have both said, like, you know, one of the main motivations for buying a platform, other than, you know, obviously, you know, creating something successful, is we just want to work with nice people. And I genuinely mean that. You know, we just want to work with nice people. You can be the smartest person in the world and you're amazing at your job. But if no one wants to work with you, you're not going to get very far. And that's the culture that we've created at Multi. Like, we're also, you know, I think genuinely nice people. We understand retail, you know, and because of the vertical integration, we understand how asset management works, property management, leasing, development. So we communicate a lot of, you know, internally, like how can we improve things, and we're learning from each other. But it's the recognition that's crucial. And I'll give you a little snippet of that. Every month, we share, so, you know, with the whole organization who we've hired. Right, it's useful to introduce them to the team, especially given that we cover 15 jurisdictions. But what I've asked them to do is also to include, sort of, you know, work anniversaries. So if people have been there like 5 years, 10 years, 15 years, we have people that have been there 40 years at the firm, and they're only 42 years old, right? So go figure. I send them a personal note, thanking them for their service. Like, you know, if you spend 10 years of your life dedicated to our business, you know, I should thank them, not the other way around. And I say, you know, I really appreciate what you're doing. Really, I think it's fantastic that, you know, people are committed to our brand and that they want to stay there. And the responses I get is like, you know, I would never want to leave Multi. It's such a great company. And I honestly think that's very valuable. I mean, I wish I had more of that in my career, that people say, like, you know what, I really appreciate what you're doing, the time you spend on it. A lot of people think that, you know, remuneration is everything, like financially, but I think it's the recognition, obviously, that's equally as important than purely the financials.
Well, it's clearly, you know, strong leadership, strong vision, evidence in sharing kind of progress, removing ego and regular updates and praising the small wins as well as the big ones. So. Yep. Sounds like an awesome kind of recipe and culture that you are nurturing. Can you, because we've danced around a little bit just in terms of, you know, $1.5 billion new mandate and offices open, can you just give me a snapshot of the business when you bought it and where it is today, and then what your plans are over the next 5 to 10 years?
I mean, when we bought the business, you know, we were probably about 600 people operating in 12 jurisdictions in Europe, not the UK yet. We then right-sized the business because, as you mentioned, it was a loss-making business. We had to, you know, right-size the business, focus on efficiencies. But we have expanded the business quite rapidly. You know, we bought a competing business in Germany out of insolvency. We set up an office in Switzerland for a particular client. We set up an office in France through the investment in Realm, we sort of have an office effectively in the UK and Denmark. So we now operate in 15 jurisdictions. We're well over 600 people, so we've grown quite a bit in terms of our FTEs. We manage about 165 assets. Estimated gross asset value is about 5.5 billion, I would say. In terms of where we want to be, we want to focus on the core markets where we are not yet, in the jurisdictions that we're not yet in, that we want to be in, are, for example, the Nordics. Yes, we have a small office in Denmark, but I think Sweden has a lot of potential. Norway, we used to be active in Finland. Tough market at the moment, but potentially re-entry into Finland as well. And like I said, I think the main growth is going to come probably from the development side. So repositioning retail, office to resi, retail to resi, and the PropTech business. The PropTech business is unstoppable. That's
absolutely. The bit that excites you.
Yeah.
So as we draw this conversation to a close, if I gave you £500 million worth of capital, who are the people, what property, and which place would you look to deploy that capital?
I'll be very honest. If you gave me 500 million to invest, I would invest everything in retail. I understand retail. I see the opportunities. But I would say one thing: as long as Multi manages it, because I have faith in our team to do the best to invest their capital wisely and add value. What I would say is, in terms of the locations, the UK has a lot to offer. We're seeing this now with our investment in UK Realm. It's a massive opportunity in the UK. There's a lot of good shopping centres. Yields are significantly higher for certain asset types than on the continent of Europe. So I would heavily invest in the UK. I think the Netherlands I would invest in just because we understand the market better. Portugal, we see opportunities. Italy, we see opportunities. All in retail, and ideally buy it, fix it, sell it.
That 500 million quid is going to get burnt through quite quickly. I get the sense. You've had a fascinating career. You're a glutton for punishment, but I can absolutely see why you fell in love with retail and the opportunities. And the list of duties that you've not the list of duties, the list of wins that you've had since you've kind of taken the business on are absolutely phenomenal. So thank you so much for sharing a little bit about your background story and some of the challenges as well. Not being a fighter pilot, not being able to buy the Morgan Stanley kind of NPL platform. But clearly, that aspiration and drive to own your own business has come to the fore. And I'm really excited to see what you and the team go on to do in the 5, 10, 15 plus years in the future.
Thank you. Thanks for having me.
Thanks for listening to this week's episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague. Give us a rating, like, or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of guests that we should have on the show or areas of the market we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockborn. The team recruit leadership and future leadership hires for real estate owners, funds, investors, and developers. So if you're looking to hire top talent for your business, head over to the website www.rockborn.com, where you'll be able to find a wealth of information, or feel free to drop me a message on LinkedIn. Have a great day wherever you are, and I look forward to catching you next time.